Investing tips for women just starting out. Hey guys, today we're going to list all the investment tips for women just starting out. Let's get right into it. Number 1. Begin investing now. If you can, start investing as soon as possible to take advantage of the power of compounding, keeping your money invested for the long term and reinvesting dividends and capital gains along the way. If you have not yet invested, remember that it is never too late to begin. Every day you invest, you are making your money work. Number 2. Maintain your investment. People may be tempted to sell or stay on the sidelines when markets are volatile, as they have been this year. However, staying the course and riding it out is often the best course of action. For example, this year's market fluctuations have been driven by daily COVID-19 news developments, but investors who panicked and sold in February or March may have missed out on the market's subsequent recovery. It can be difficult to ignore the headlines, but experts advise against trying to time the market. If you do, you risk missing out on some of the best performing days, which can make or break your long-term return. Similarly, if you're investing for the long term, you shouldn't be concerned about starting at market highs or lows. If you prefer not to invest in one lump sum, consider spreading it out to reduce your risk of market fluctuations. This is a common concept known as dollar cost averaging. Dollar cost averaging is a powerful tool for overcoming fears of investing at the wrong time. Number 3. Begin with asset allocation and work your way up to a well-diversified portfolio. Asset allocation is a personalized mix of stocks, bonds, and other types of investments based on the risk tolerance of the investor. It is the foundation of investing, accounting for more than 90% of long-term portfolio returns. Single asset class performance can vary greatly from year to year, with the best performing asset class this year becoming the worst performing asset class the following year. The key is to diversify your investments across asset classes so that your overall portfolio is less vulnerable to the ups and downs of any single asset class. A diversified portfolio can provide a higher return for the same risk and a smoother ride. Number 4. Risk is not a dirty word. When it comes to investing, risk is an expected factor that should not deter investors from pursuing a long-term investment strategy. In today's low-yield environment, the return from lower-risk assets such as cash cannot keep up with rising living costs and may result in failure to meet return objectives in the long run. According to experts, risk is the active ingredient in achieving specific return targets. Typically, the higher the desired potential return, the greater the risk an investor must accept. After all, they say that there is no reward without risk, and this is a fundamental principle in investing. A well-diversified portfolio can assist in risk management without completely eliminating it. Of course, investors must accept that individual investments in a specific stock, bond, or other investment may lose some or all of their value, which is why a well-diversified portfolio is critical. Number 5. Avoid panic selling. You may feel compelled to sell when the market is down or your investments begin to lose money. However, this is a sure way to lose a lot of money. When everyone is scared and the news makes it appear as if the world is ending, it's natural to panic sell. However, you must resist. Markets always recover, and panic selling destroys compound interest and costs you thousands of dollars over time. There may be times when you need to sell something or transfer money, but do so sparingly. Maintain your investments and you will reap the benefits in the long run. Remember, don't buy high and sell low. Rather, market lows are a buying opportunity for long-term investors. Number 6. Learn the buy and hold approach. A buy and hold strategy is a passive investment strategy in which an investor buys mutual funds or stocks and holds them for an extended period of time, regardless of market volatility. A buy and hold investor actively selects stocks while being unconcerned about short-term market fluctuations or technical indicators. Many well-known investors, including Warren Buffett and Jack Bogle, advocate buy and hold strategy for investors seeking healthy long-term returns. The purchase of Apple stock is an example of a potentially profitable buy and hold strategy. If an investor bought 100 shares at $18 per share in January 2008 and held them until January 2019, the stock would have risen $157 per share. That's a nearly 900% return in just over 10 years. It is important to note, however, that past performance is not a guarantee of future results. Number 7. Index funds. As a beginner, and if you want to remain a risk-averse passive investor who follows the market, an index fund is your best bet. Every country has its own stock market index. We have the Nifty and Sensex, which represent the top companies and serve as the benchmark for our market. Investing in an index mutual fund allows you to reap passive returns by incrementally replicating the index. As the index grows, so does your investment. However, as the market falls, so does the index fund. Number 8. Do not give in to FOMO. Don't let FOMO cloud your judgment as you see everyone diving into the investing end of the pool by investing in cryptocurrency or meme stocks. The fear of missing out can be disastrous for those who are unfamiliar with investing and do not conduct adequate due diligence. Crypto markets and meme stocks are highly volatile, and while the returns may appear to be lucrative, you will lose everything if and when they crash, and you must be prepared for this when investing in such things. That's all for today, and we'll be sure to catch you all in the next one.